You know, for the last couple of years, the whole story around AI has been about growth, right? Efficiency. But underneath all that hype, something much deeper, something way more mathematical has been brewing. And this isn't about next quarter's earnings report. This is a structural reckoning. It all comes down to the very formula we use to value the biggest companies on the planet. To really get what's going on, we have to look past the headlines and dive straight into the math.
And this quote, it just nails it. We are watching a violent repricing unfold, not because of what AI is doing today, but because of the terrifying questions it raises about business models 10, 20 years from now. The fundamental assumptions that propped up software valuations for a decade, well, they're basically going up in smoke.
So that brings us here to early 2026, and on Wall Street, they've already coined a term for it, the SaaS apocalypse. It's this moment where the darlings of the software-as-a-service world are facing a full-blown existential crisis, and the market is just scrambling to figure out what the future actually looks like.
But here's the thing, this isn't a broad market crash, not at all. If you look at the numbers for early 2026, the Dow was actually up. The S&P 500 is totally flat, but the tech-heavy NASDAQ, it's down. Right away, that tells you the pain is concentrated. Something very specific is hitting the tech and software sectors and leaving everything else alone.
Yeah, that concentration of pain tells you everything. This is not just another dip. We are witnessing a structural recalibration of what these companies are fundamentally worth. Investors are waking up to the idea that solid near-term earnings might just be a smokescreen for a much, much deeper problem in their long-term value.
The entire psychology of the market has done a complete 180. Just a year ago, AI was seen as this incredible tool that would supercharge software companies, a huge tailwind. Today, that exact same technology is being viewed as a fundamental disruption risk. It's a force that could commoditize their products, crush their pricing power, and just evaporate their competitive moats.
And that brings us to the real heart of the issue, what we're calling the terminal value paradox. This is the hidden mathematical time bomb that explains why the market's reaction has been so swift and so severe. So, let's unpack it.
Okay, so first things first, what even is terminal value? Well, in simple terms, when analysts try to value a company, they map out its cash flows for, say, the next 5 or 10 years. Terminal value is the single number that represents the value of all the cash flows after that, from year 11 all the way out to infinity. It's basically the "and they all lived happily ever after" part of the valuation story.
And this is why it is so critical. For most of these high-growth tech companies in the S&P 500, a staggering 60 to 80% of their stock price today isn't based on what they'll earn in the next decade. No, it's based on that happily ever after number, the assumption of stable, predictable growth forever and ever.
Now, this is the formula they use to calculate it. But don't worry, you don't need to be a math whiz. Just focus on those 2 letters at the bottom, R minus G. Think of R as the market's anxiety level, the risk rate. The more nervous investors get, the higher R goes. And G is the perpetual growth rate, how fast the company is supposed to grow forever. The entire happily ever after story depends on the tiny gap between that anxiety and that speed. And this is where AI creates a mathematical crisis. It's a pincer movement on that formula. On one side, AI makes the future so wildly unpredictable that confidence in long-term growth, RG, just plummets. At the exact same time, all this uncertainty means investors demand way more compensation for taking the risk. So the anxiety level, RR, shoots up. That gap between R and G shrinks, and the whole valuation just collapses. And the math here, it's absolutely brutal. This isn't a gentle slide, it's a nonlinear collapse. Get this, if you just lower that long-term growth rate, G, by 1% and raise the risk rate, R, by 1%, boom, you can wipe out nearly 30% of a company's entire value, just like that. That's the violence we're seeing in the market.
Okay, so now that we understand the how, let's get to the who. How can we actually figure out which companies are the most vulnerable to this terminal value collapse? Well, let's walk through a framework for assessing that risk.
This framework breaks down the AI disruption risk into 6 different layers. It's designed to go way beyond the simple stuff and ask the really fundamental questions about a company's business model, its data, and its real place in this new AI-driven world.
Let's just zoom in on a couple of these, because they are really telling. Layer 2 is what we call the seat-based trap. Think about companies like Salesforce or Workday. They built absolute empires by charging a license fee for every single human user. But what happens when one AI agent can do the work of 1,000 humans? That revenue model isn't just a problem, it's a terminal liability. And this leads right into another huge point of failure. Layer 3,
which is owning the system of record. A company like ServiceNow provides a fantastic user interface, but they're at risk because a powerful AI agent can just bypass it. It can go straight to the data. But a company like ADP, they own the legally binding system of record for payroll. They own the truth. That is a much, much harder moat for AI to cross.
So as you can imagine, this massive recalibration is forcing a huge rotation of capital. Money is on the move big time. So if everyone is fleeing these vulnerable software models, where's all that money going? What does the inverse AI trade actually look like?
We're seeing what you could call a great rotation from bits to atoms. Capital is flooding out of intangible software models and seeking refuge in companies with tangible physical assets. And why? Because their competitive moats are protected by things AI can't just replicate overnight. We're talking physical infrastructure, regulatory hurdles, and real-world supply chains.
So this means entire sectors like utilities, energy, and industrial giants are suddenly looking like the safest ports in the storm. Their long-term value is seen as more durable precisely because AI can't automate a power grid, it can't drill for oil, and it can't build a tractor. Their moats are made of steel and concrete, not just code.
But look, this disruption isn't just about picking winners and losers in the stock market. There is a potential systemic risk here that could ripple through the entire economy. It's a speculative theory, for sure, but it's one that's gaining a lot of traction.
Researchers have mapped out this potential deflationary feedback loop. It goes like this. AI gets better and cheaper, so companies lay off their expensive knowledge workers. But those displaced workers, who are a huge part of consumer spending, they cut back. That weakens demand, which forces other companies to invest even more in cost-saving AI, which, of course, leads to more layoffs. It's a spiral with no obvious break.
And this brings us to the ultimate paradox at the heart of this entire shift. This quote captures it perfectly. The very engine of disruption may be so powerful that it ends up breaking the system that was built to fund it.
Which leaves us with this final massive question. The billions of dollars being poured into AI are justified by the promise of enormous long-term returns. But what if that same AI makes the long term so uncertain, so foggy, that our markets can no longer even price it? Has the disruption become self-defeating? Has it broken the very capital markets meant to fuel it? That's the fundamental question the market is wrestling with, in real time as we speak.